Hey everyone, welcome back to the channel. It's Demetrius, and in today's video, I want to walk you through a story of a client that I've worked with. He's a guy who's incredibly successful in business. He's made a lot of money, and he understands investing really, really well, but he still wanted something safer and more stable inside of his portfolio because he wasn't looking for whole life insurance or anything like that for a get rich quick plan. He wasn't looking for something that's going to give him a huge rate of return. He wasn't trying to do any of that. He was just trying to diversify with a tool that wasn't tied to the market, something that he could count on for future income, for future legacy. And he took the approach of, why put all my eggs in one basket and expose myself to more risk than absolutely necessary. And so if you're watching this and you want more control, more predictability, a smarter way for future retirement income, this is going to be incredibly relevant for you. So tune in all the way to the end and let me know what your take is on all of this by the end of the video. And so in the life insurance world, before we hop into the nitty gritty of my client, in the life insurance world, especially those who kind of adhere to the infinite banking side of things, you hear a lot of talk about using life insurance to build wealth, to become your own banker, to become a millionaire and all of that. And listen closely, I'm not here to say that any of that's wrong, that I don't agree with some of it. I'm not saying any of that. But I also think it's important to anchor things in reality, right? To anchor all of this in reality to a large degree, because while it's fun to dream about the possibilities, it's even more meaningful to talk about how everyday people, even really highly successful people, are actually using these policies in their everyday real financial lives. And so I believe that everyone needs a safe, stable asset in their portfolio of some kind. That's my core belief. And when it comes to long-term safety, I don't think there's a better option than overfunded whole life insurance. Okay. And so I want to, shift things over to the client that I talked about as an example. We'll call him Adam for today. Okay. He's an executive. He does really well for himself, makes over $1.2 million per year. And believe it or not, he works at a financial firm of all places, right? And so given the nature of his work, he fully understands how bonds are typically the safe component, the safe part of people's portfolios that they put together. But after doing his own research, he wanted something even more stable than that. He wanted something even more stable than bonds, something that wasn't tied to market performance at all, right? He knew bonds were less volatile than stocks. Like, that's a given. He knew that. But he also realized that an overfunded whole life insurance policy has even less volatility than that, with similar, if not better, long-term growth. And there's also not going to be any direct correlation to the market for him either. And so what he did was this. He ended up contributing $150,000 in his own policy for the first year. And then he plans on contributing $50,000 per year moving forward from there. But that's not all he did. He also set up policies for all of his 3 children as well, contributing $10,000 per year to each one of those policies. And so his total first year contribution, we're looking at $180,000 per year. He's contributed that. And then moving forward, his annual contribution is going to be $80,000 per year. Granted, there's a lot of flexibility that goes into that. Feel free to just kind of watch some of my older videos about that if you want to learn more about that. But just know that that's what he specifically did, right? He knew that bonds were safe. He knew that life insurance is safer. You're going to get similar returns. And with a death benefit, it was a no-brainer for him. All right. And one of the things I want to mention as well, outside of the videos that I've created and will continue to create, this kind of strategy has a lot of people curious. And if you want to see exactly how overfunded whole life insurance works, I put together a very simple, straightforward guide that does explain all of it. It breaks down what overfunded whole life insurance is. It breaks down what it is not, who it's for, who it's not for, and how people actually in real life are using it, including some of the details about how contributions work, how cash value grows, all these sorts of things. So go ahead and grab the guide for free. Go ahead and you just use the link below in order to do that. And if after reading it, you want to see how this could actually work in your own situation, there's a spot right inside of the document for you to schedule a time directly with me. And again, it's totally free, no hard sales pitch, just a real free education and a real strategy. Now for Adam, it was about having an asset in his portfolio that was not subject to market swings, something that could help him ride out the volatility and give him more control over when he draws income once he's entered into a retirement period of life. And so for his kids, it was about giving them flexibility, like giving them a financial foundation, something that they could access for college, for a business, for a down payment on a home, whatever life brings, without penalties or strings attached or any asset telling them that they can only use it for a particular thing. That's what he valued for his kiddos. Now here's the part I think more people need. Now here's the part I think more people need to hear, okay? Adam was using life insurance as a retirement income buffer. He was using it as a way to protect his overall portfolio and give himself flexibility when it matters most. And so when the markets are doing really well, he plans to draw from his market-based assets. When the markets are not doing too hot, he can pull from his life insurance policy instead, which would give his market-based investments time to recover without locking in his losses by selling low. And so, of course, he also has the long-term protection of the death benefit as well, which adds another layer of legacy planning, which again, he thoroughly enjoyed because he loves his family. He want to make sure that he can maximize what he's leaving no matter what. And so this is how high income earners and even everyday savers are using whole life insurance, and they're doing so in the right way and without the hype. They're not using it as a magic bullet, but as a smart, stable, and flexible part of a well-rounded financial plan. So if you ever wondered how a properly structured, overfunded whole life insurance policy fits into a retirement strategy, this right here is it. And if you want to learn more about how this could work for you, or if it works for you at all, I would love to connect and be the guide for you if that's something you'd want to do. And so if you'd rather, though, not worry about any of that and just keep learning, go ahead and check out one of these two videos here that YouTube thinks you'll want to see. So thanks for watching. I'll see you next time.